Ventures. Yeah. Okay. Hello? Great. Welcome to the exit panel. We'll be looking at strategies for profitable exits in the current macroeconomic environment. My name is Margaret O'Connor. I'm the chair of Launch Africa Ventures, the largest seed stage investor in Africa. And I'm also a former tech entrepreneur from New York City. I started, scaled, and sold a company early in my career and have spent the last 20 years investing in African startups. It's my great pleasure to introduce you to some very experienced private equity investors looking at very different opportunities. Alexandra, if you could start and just give a brief introduction, and each panelist will have an opportunity to introduce themselves.
A disclaimer, I'm the only non-investor. In terms of main line of work, my main line of work is to help companies and funds raise capital, primarily from European sources. So we're a placement agent, M&A advisor. We help companies raise capital. I've been doing that for the last 20 years. Before that, I was a tech entrepreneur myself as well, sold a company. And that, in the process, actually, we had started a platform in Africa, which was part of the sale of the company, which was the first time I did business in Africa. Ever since, we've been working with funds, helping them raise capital. Therefore, we have a view on why exits are so important to them.
Cool, thank you. Kasif?
Good afternoon. I'm Kashif Isaacs, head of the private markets team at Mergence Investment Managers. We run about $220 million across South Africa, Namibia, and Lesotho. So if you know a little bit about the region, we're actually investing in one of SA's largest markets in the form of Africa's largest markets in the form of SA, but also in one of Africa's smallest markets in the form of Lesotho. So we've got very different challenges when it comes to setting up an opportunity for an exit.
Thank you. Asfana?
Great. My name is Afsana Ejeta. I am the co-founder and managing partner of a business called Alta Semper Capital. So I've been in the private equity space 21 years, and for the last 12 years exclusively investing in Africa. We've invested probably $160 million in the continent on behalf of DFIs, fund of funds, family offices, almost exclusively in the healthcare space. We've made 5 investments, and in the last year have had 2 exits, partial exits, which were great, but also a lot of work, and happy to share our experience on that. And we very fundamentally believe that being sector focused on the continent is a great way to approach the continent to bring expertise in sectors we know well, and do actually fundamentally feel it helps underwrite investments and prepare them for an exit. One of the things we're very excited about in the healthcare space in Africa is also finding a way to mobilize businesses being ready to list, but also bring multinational companies to the continent, which we think will be very impactful for the continent, but also really help institutionalize and grow capacity in the healthcare sector.
Thank you. Mark Oliver. So apologies to Mark because AFSIC has failed to include his bio.
I think it's going to be okay.
Yes. So Mark Oliver from DEG.
Yes, I'm with DEG. My name is Mark Oliver Uneman. I'm with DEG. I'm about 13 years now with the company. Before that, I worked here in London in debt capital markets as a portfolio manager for CDOs and ABS. Yeah, I mean, for us, I'm part of the FI equity team, so we only do direct investments in the FI space, means all sorts of lenders, but also insurance companies, asset managers, fintech, across Africa, but also in other regions. I mean, for us, Southeast Asia, India, and also Mexico being a very important region. For us, Africa is actually a challenging, but also a very exciting environment, and we have high hopes for specific markets in Africa, I mean, to gain traction and to give us also very good returns, particularly bigger markets like Nigeria, for example, East Africa, but also Egypt. We have very high hopes. We are currently putting a big focus on those countries which we deem as strategic.
And Franklin.
Fantastic. Rounding off here, I'm Franklin Olakunle Amo. I am the managing partner and founder of Bayless Emerging Markets. We're an investment firm focused on Pan-African investments, advising a maiden sort of flagship private equity fund. And we're sort of unique and interesting, and the reason why we're on this panel is because we essentially established the fund around a private portfolio of assets that was then managed by the fund. The fund itself is backed primarily by U.S. family offices. And so there was an interesting transition of taking essentially private companies and bringing them into institutional ownership and management, which has been an interesting journey. We're headquartered in Lagos, Nigeria, where I spend most of my time, but we have offices in New York, Nairobi, and Dakar, Senegal.
Thank you very much. And so just to provide some context and connectivity to some of the other panel discussions here at AFSIC, so when we started to think together about exits in African private equity, we see three main macroeconomic trends influencing the exit landscape for the next 10 years. Number one, the demand for African mineral resources and agricultural resources will remain buoyant. The mix of assets will change, and there will be ESG strings attached to some of these mineral and agricultural resource investments. Number two, technology is completely changing the way people in Africa work, learn, play, and interact. And that's obviously a central theme in a number of the organizations here. So technology as a positive disruptor and force for innovation and job creation is a key theme. And number three is poor government and governance will remain a challenge in Africa. And that's a topic that many of the AFSIC panels address. And this is clearly one of the considerations in crafting an exit strategy for everyone on the panel. And in our preparatory discussions, governance was a key theme across all geographies and asset classes. So I thought we'd start with just a general observation and some anecdotes about opportunities to create life stage appropriate and regional appropriate governance in some of the companies in which you invest. And so since you represent quite an interesting mix of client organizations, if you would just start generally with what you see from a governance perspective in African private equity to attract more investment to Africa, what do you see, what's on your checklist?
And let me build on what you just said, just to zoom down onto exits. The first thing I would say is that exits are important for Africa. As we know, a lot of investors have been waiting for meaningful exits. They are coming, they've been in the making, there are more coming, but at the same time, still needs to be more exits in the market, and we all wish for that, and we're working to make that happen. Why exits? Not only for the market, but also for our GP. It's very important to, of course, for the track record, but to have the ability to redistribute some of that money to the LPs so they can reinvest in the fund. It's very mechanical. It's also good for the carried interest for anyone involved. But also, it's also to show that the model is working. The model of governance, the model of creating value, and the model of creating value with private equity, with private capital. Now, talking of governance, maybe one last point, talking about just generalities there. Many LPs I work with, when we present a fund to them, they like to see, for instance, multi-regional, multi-country funds. Why? Because when you look at exits, sometimes you could get stuck technically in a country where there's geopolitical unrest or where there's a specific issue, with foreign exchange or repatriation of capital. Therefore, a lot of LPs like to see, at least the ones I work with, which tend to be more on the commercial side, they like to see pan-regional funds. Now, talking about specifically about governance, and I think it's a common theme, right, on this panel and on the conference. The first thing is obviously looking at governance, how to create value from inception, from the investment until exit. A lot of the exits will happen not only on the stock markets, although it's a very limited route for exits in Africa, but with large corporations or large private equity funds. When they buy into a company in Africa, they don't want to run a reputational risk, and they want to make sure everything they do there is going to be according to their standards. And now, obviously, it's governance, also anything to do with impact and environment. And I won't it's not,
Right.
I'm not spoiling anyone's comments there because I'm not an investor. I'm just noting that those GPs that raise effectively are able to show at the beginning of their investment how they address those issues. They get into a company, they can demonstrate to the limited partners that they've addressed those issues. They've set up milestones before the investment or after the investment, and they compare the progress of their portfolio company against those milestones towards exit. And I'll stop there because...
Right, I was going to say, I think, the milestones and being transparent about what the KPIs are and communicating immediately with your LPs if things evolve and you need to make some pivots. But just again, continuing on the theme of governance, I think with your current investments in Lesotho, you've been through quite an interesting process of navigating uncertain regulatory regime there around cannabis. So if you could share it with us.
So we've invested in 2 medicinal cannabis farms in Lesotho, which at the time of entering those deals, the landscape was still murky. So we still had the Drugs of Abuse Act, which classified cannabis as a Schedule I drug, but we had this body of regulations which now permitted from seed to final product the cultivation and processing of medicinal cannabis. And sort of the other aspect that's quite sort of different for smaller markets in Africa is we only look at assets where we can externalize that product. So we're looking for assets that will attract or be able to sell hard currency revenues outside of their home market. There's developmental benefits in that. There's attracting hard currency revenues to small economies, getting brand Lesotho better known in the global landscape. So a lot of our cannabis, for example, is distributed into the German market. Similarly, we invested in a trout farm, and we're supplying trout now to Asia, the US, and South Africa. Coming back to the governance theme, that sort of fundamentals for us around backing strong management teams, selecting them carefully. We've walked away from deals where there's too big patriarchal or matriarchal setup, and it's still that sort of family-owned business mentality, and not in our view, ready for institutional governance and the appropriate structures around that. But yeah, you need to, and the exit discussion, it's one of our biggest debate points at investment committee. We need to have clear thinking, clear milestones, and clear expectations around what a realistic exit will look like for that particular portfolio company.
If I could just do a follow-up, my understanding is you would have been one of the first investors in African cannabis with European export. So without any clear precedent about regulation, never mind exits, can you maybe talk a little bit about how that added to the time or cost of structuring these investments?
Yeah, sure. So it was interesting when we did the first deal, there was a lot of uncertainty around what the import regulations would look like in our target markets. And then sort of 12, 15 months after writing the initial investment check, EU GMP or EU Good Manufacturing Practice became the de facto standard for being able to import cannabis or import cannabis into most of Europe. So we had to go through a sort of pivot in terms of not sort of the fundamental design of the facility, but a lot of the SOPs then had to be tailored to be compliant with those regulatory standards. And that added, 2 more capital calls.
Oh, wow, okay.
We were not only...
Patient capital.
But it's also important, so when we did the transaction, we looked at who's sitting next to us around the table. We wanted, because of that uncertainty, we wanted investors with deep pockets. It's easy for the rest of the investors to say, okay, the pension fund is there, they've got the deepest pockets, we'll knock on their door. And we were very careful of that to make sure that we had large family offices, private wealth sitting next to us. And when those capital calls came, we actually opted into one and out of another, because we knew there were other parties around the table that could respond.
Right, and getting investors who are with you for a journey towards a clear
Exactly,
exit.
yeah.
Excellent, thank you. Esfana, clearly you've had a lot going on with governance. Can you talk about some of the lessons you have learned as a health investor in Africa?
Sure. So we've been invested in Africa sort of 5-6 years through our vehicles and our funds. I mean, we take a very specific, narrow approach to the types of deals we do. So we only invest in controlled deals. And part of the reason for that is we really want to be in control of all the sort of meaningful operational governance, reputational risk issues at the onset. And we've passed on a lot of deals where, whether it's the founder, whether it's the company, whether it's a shareholder group, can't get comfortable with ceding control to a new investor. And so we often find control is a nice to have when things are going well and things are rosy and there's no economic turmoil or geopolitical or climate issues, et cetera. But for us, it's really a need to have when things are not necessarily going well. And I think in a way it's allowed us to salvage situations that were difficult because we have been able to take tough decisions and push through our agenda, which we feel was in the best interest of the company and the stakeholders. So, you know, we do control deals and generally large investments. Our average ticket is sort of $50 to $60 million into, you know, an enterprise in Africa. So we do think very carefully about governance from the onset. We often also always, in addition to having control, have a dual reporting line. For example, the CFO of the company will also report directly to the board in addition to the CEO, because controlling the cash and having to make difficult decisions around spending is also important for us. And just giving us the comfort that we have visibility into how our investment is being managed also gives us comfort to potentially deploy more. And in one of our businesses in Morocco, it's a buy and build. We invested when the business had 3 assets. By the end of this year, it will likely have 14. It's one of the larger hospital groups in North Africa. And that was a business where we staged our capital in over time. And because we had a super majority stake in the business, we controlled the board, we have a very collaborative relationship with the founder CEO, allowed us to actually invest significantly more than we thought we would at the beginning, even through, you know, difficult macroeconomic times. So for us, having, you know, control over the shareholding, the board, and having very strong reserve matters from the onset. You always hope you don't need to use them, but sometimes you do. And for us, that's a pretty clear line about the types of deals we'll do.
And when you talk about operational risk and reputational risk, operational risk, you know, you can see a clear checklist, and that would be obvious probably to others on the cap table. Reputational risk to me sounds like it has the room for a lot more interpretation. Could you maybe share kind of what are some of the components that go into assessing reputational risk?
Absolutely, right. So one of the things we pride ourselves in hoping to bring to our portfolio is providing access to safe, affordable, best-in-class healthcare to our constituents, right? Mm-hmm. So one of the things that would be disastrous for us as an institution is if, for example, there were counterfeit medication found in any of our stores, okay, or like best-in-class ethical practices were not being employed in our hospitals. So part of the reason also we tend to take a controlling stake in businesses and also, you know, chair the audit committee, chair the remuneration committee, get very involved in sort of how we negotiate supplier contracts is we need to make sure we're sourcing from credible counterparties. We need to make sure that there's no way in which, you know, kickbacks are being paid to doctors to get referrals, because our hope is eventually, you know, large multinationals will want to acquire these businesses, bring further capital, further expand. I think the people we partner with and the management teams we bring in are also really important. And often, you know, sometimes we have to bolster our transition management and bring in multinational management, which we've done in 2 of our portfolio companies to prepare those businesses for a sale. And that's often a natural progression of many businesses, but it's not just, you know, the reputational risk of who we're partnering with, but also what type of provision are these businesses providing to the market is as important to us.
Thank you. Mark Oliver, I think on the governance, you can provide some interesting insight and anecdotes about the contrasting the governance practices you see at DEG in Africa, Southeast Asia, and Latin America. If you can, and Asfana talked about preventing reputational risk management, preventing the incidence of kickbacks as someone who spent her early career in Asia, you know, what corruption looks like in different geographies, you know, same or different, be interested in your analysis.
Well, our approach to governance, I mean, I see it more like, I mean, from the very onset, I mean, governance is a key issue to us. And it has two broader aspects. First of all, it's the framework, basically, that the country sets. So we normally take a very close look regarding the regulatory conditions and the legal conditions in certain jurisdictions. And the second aspect is then what we find in the company. So, I mean, we look at startups, we look at businesses which are family run for a couple of generations. So we find really a completely different set of companies we work with. And in the second aspect, that's also something where we focus a lot of technical assistance on. To get that basically, if we identify any problems, to get that straightened out. Because it's our experience that this is also very, very key for successful exits. I mean, I think we recently looked at our exits, and there was hardly any kind of successful exit where that wasn't really backed by a sort of a extremely well-managed governance framework within the institution. Obviously, what's then also playing a very big role is the external framework, and there, the countries in these various regions, I mean, they diverge quite a bit. I mean, we found, for example, when we take a global look, for example, in an economy like Mexico, we found very skillful regulators and with the appropriate staff at the regulation, but also with a very advanced regulatory framework. So in the end, we found that a very stable environment. As opposed to that, for example, we did an investment in Myanmar, that was a couple of years ago, which was completely the opposite. So it was it's a very difficult regulatory framework. You don't really get answers to many of the questions you have. And in the end, you're operating a bit in a gray area, and if you want to operate in such an environment, you have to take to a certain degree, or you need a high tolerance for reputational risk. That's basically, otherwise, that's at least our experience, it's very difficult to do deals in these countries. In terms of the internal sort of challenges, let's stick to the Myanmar example. That was, for example, there was a situation where we found investors who were pretty much, other investors who were very much like-minded. So the sponsors were very much like-minded. So internally, we made great advances, I mean, to implement an appropriate governance system. And the company, in this regard, that worked out very well. So it's a bit, to us, it's a bit of a combination. The internal, basically, willingness of the sponsors, the management, all the stakeholders to work on the governance side, to achieve at a certain point in time a successful exit, and on the other hand, to get that aligned basically with the external framework, what we find in those countries.
Thank you. And Franklin, if you could pick up on the contrasting the willingness and the ability of the internal parties and the regulators in Nigeria, right? Because this is one of the markets that obviously has attracted the most investment capital in Africa in the past few years. So being on the ground, I'd love to hear your experience.
Yeah, no, it's an interesting question. I think, there are two things I would say that I think could be constructive. I think you need to explain to your local counterparties, the seller that you're partnering with, the purpose of governance, right? In a way that makes sense to, their priorities, right? And I think one of the most compelling arguments is that improving governance, improving reporting in particular, expands the universe of potential interested investors and partners for that business, which in and of itself increases the value of the business, right? Because, we're involved at the moment in a telecoms acquisition in West Africa. It's a significant business. It's certainly significant for the country it's in. I think that, and there is a government ownership component, a significant one, and the regulator is highly involved. And I think that they were surprised by how limited the audience was for this asset, right? And there are a number of factors that come to play in that. But certainly there's a perception that, there could be a lot of issues getting in and out of this business, and managing it could be costly, right? For a return that could be interesting but could be found elsewhere, right? So money's fungible and all that. Now, I think two things are true, right? Because local regulators tend to be both more sophisticated and less sophisticated than you expect, right? Because when you go there, it's not like they haven't heard of the tools and they're not familiar with the sort of best practices. There are just very real costs, and I think we talked about this in the prep call. I mean, governance is expensive, right? And you do it in markets like this one or the U.S. or wherever because you have to. The penalty for not doing it is significant. And sort of the upside of not doing it is capped, right, by the sort of environment. But when you're operating in a world in which that may not be the case because either regulators are captive or, underfunded or under-resourced or don't have the energy to pursue it or the incentives are not there, then you really have to do a really good job spinning a narrative to your partner, right? Because, we also sometimes look for control, but sometimes we don't. Sometimes we focus on just having a fulcrum type of security investment. So you're not necessarily at the table with the most leverage all the time to a family, even if you have control, right? And it's a family that's way more influential locally than you'll ever be. Even having control doesn't always get you there. You sort of have to explain to them in a persuasive way, which is really hard because there's not always a great answer at the beginning of why are we doing this, right? Like, what is ESG? Why do we care, right? And to people who've been successful, right? Who've been really successful in a really challenging market.
Well, and if we could stay with Nigeria for another moment, Asfana, so in terms of regulators are captive and government challenges, and we have some of the smartest people in Africa working in government for some part of their career. And how do we, as investors working to successful exits, help the regulators and others in government understand the economic development imperative of transparency and predictability in the regulatory regime? So, Asfana, if you want to maybe share a little bit about that.
Yeah, it's a great question. I'm not sure I have a perfect answer, but can give some sort of anecdotes of what we have done that has hopefully contributed on some level to our success. So we tend to, at the very onset of thinking about investing in healthcare business in Africa, even before we invest, engage the regulator, right? So it's a blessing and a curse, because in many of these sectors, healthcare is heavily regulated. It's not ostensibly open to foreign capital. So in many of our transactions, we've had to engage the regulator early and almost, prepare a dossier of what is FDI and why is it a positive thing to bring in private equity capital to, a pharmaceutical business or an oncology business. Why is it not necessarily the best thing for these businesses to all be owned by doctors and pharmacists? Like there are, foreign capital come with more capital. They come with the backing of many of the development banks who have made huge strides in terms of ESG, impact, governance, gender empowerment. A radiotherapy bunker also happens to cost $2 to $3 million to build. There's some very successful Moroccan doctors, but not sure they all have the money to kind of build capacity. And so most of the regulators we have found in Africa, most of them being indigenous Africans, care deeply about expanding healthcare capacity in the market, and so have tended to be really a symbiotic, successful force for us locally, that once they understand that we're not bringing just money, but we're bringing the power of international institutions, we're bringing multinational talent. In many of our portfolio companies, we've appointed former GSK, Reckitt Benckiser, managers who are also bringing best practice to those countries. So we do tend to engage the regulator early and kind of thus far unfailingly have been able to convince them that bringing in foreign capital is important. But also, within our portfolio companies, out of the 1,000-something people we've employed, I think every single one of those people are indigenous Africans from their home country. So also the power of job creation. And also, it is a source of pride for local countries and local governments when multinationals do invest in a business or when that business does go public locally. And so being able to show the case studies that, we invested in a family-owned business in Egypt, started by 2 pharmacists. We then institutionalized the business. We brought in a CEO who was Egyptian but had worked at Pfizer, et cetera. And then now that business is listed on the Egyptian stock market with big institutional investors is a great case study. And along the way, we doubled the number of women in management. And we were able to put in place ESG training and reduce the amount of waste and help the local government through COVID. So being able to show us creating things other than just financial return, I think makes for kind of a virtuous circle and helps the case for foreign investment.
Thank you very much. Alexandra, since picking up on the theme of multinational corporations beginning to look more closely at different asset classes of African companies, can you maybe provide us with some examples in your client base when you're beginning to, it sounds like you start your engagement with the exit in mind and reverse engineering a lot of the workflows, but just the changing evaluation multinationals are making in different geographies towards African investment.
A couple of thoughts there. I mean, there are two notions. One is looking at exit from the beginning when you make an investment, and also talking about corporations as LPs. So I'll just draw on those
good point. Yeah.
two topics. The first one is when you start making an investment is looking at the exit routes for the company. I've seen a couple of deals with our GP clients recently where at the beginning they were really looking strategically at which corporations would be the acquirers of their companies. And so while focusing on a very competitive region, for instance, in a country, they started to do a build-up in the neighboring regions to create the second or the third alternative player in a given country so that the corporation would eventually look at them to acquire their portfolio company and create a successful exit. So there was a deliberate purpose at entry to look at who will be my buyer. And many of the sophisticated GPs do that now. It is something that's come along the way in Africa. The early exits in Africa where a lot of the sales were to the management of those companies. Mm-hmm. And now more and more people are turning to outside investors, corporations, and obviously governance is a big part of this because if you're willing to sell to a multinational company, if you're strong on the ESG dimensions, and you're definitely ahead of the pack. Now, talking about corporations as LPs, which we do as well, we brought a few large companies as LPs into funds. And when they look at this, sometimes the first reaction is, why would I invest in a fund? And the key question is, are you looking strategically at Africa? And if so, are you willing to go full speed, or would you rather play by putting a total investment into a fund? And first of all, it should be a good financial investment. You will not lose your money. In fact, you may as well make a lot of money. Second, you will observe what is going on in the portfolio company and get to know a specific industry, a specific country. And you see a lot of those corporations now putting a bit of money, especially also it's off balance sheet. So you have to explain to them that if they commit to a fund, now they know, but some of them you still have to explain to them that when they commit to a fund, they will not be drawn down immediately, so that by the time they finish to be drawn down, they might as well start to see some returns. Now the tricky part is when they become LPs in a fund, is to explain to them that yes, they could be the eventual buyers of the companies in their portfolio, but they are not the only ones. And so some of them might think that being an LP in a fund gives them a priority at exit. It doesn't, because the LP limited partnership is what it is. And you need to provide the best exit for all the limited partners. But if you have been observing a company under the microscope for so many years, you know you have an informational advantage. So you know if you want to bid and when. So that is something that's appealing to some corporations.
And just in looking at the different categories of multinationals who are evaluating Africa, right? You have a lot of unicorns in Africa or in financial services and fintech, now education. We have active investor in healthcare. From your experience, Alexander, are there particular types of multinational that you're seeing an uptick in interest for potential African exits?
It's really case specific, obviously, if you're.
Yeah.
Multinationals will look at the geographic that they're interested in. Sometimes they might be already operating in, say, West Africa, and they might want to play in East Africa, but they're not sure how to do it. They might go through a fund. Others might say, look, we want to do healthcare, or we want to do telecoms, or but we're afraid of Africa. Why don't we go through a couple of limited partnerships to see how things are moving? But no, there's no single answer.
Yeah, no, and at Launch Africa, we have lots of conversations with multinationals in, US, Europe, and UK about expanding even their corporate venture capital investment strategy to include Africa. So organizations like Unilever that are super active in Africa have never done a corporate venture capital deal on the continent. They have a very small foundry office in South Africa. Pfizer, the same thing. So I think there's an ecosystem interest in educating multinationals about the opportunities to extend their existing corporate venture capital vehicles to include the high growth opportunities in Asia. So I really see that as a collective responsibility here. And then Kasif, as one of the pioneers in cannabis, I'm curious to what extent, in terms of educating multinational investors, have you seen a growing interest for US and European investors in the sector to come look at your assets and look at other opportunities across Africa?
Yeah, we've seen the big focus has been on offtake. So guys want to come and, because the one site is now GMP accredited, there's a lot of interest in distributors who want to then just procure product and supply into Germany, Israel, and all of the markets where medicinal cannabis has matured and is now available on national healthcare plans. In fact, and we are starting to see, in fact, we're just closing now $18 million expansion raise out of the Middle East to take that facility to the next level where we can offer multiple strains, and multiple products to those markets. So it's definitely shifting from pure, we want to buy your product, to saying we see an opportunity to scale this business into a true global player. So we're starting to see that shift definitely in the market. Yeah.
And so, Mark Oliver, just again, taking advantage of DEG's exit team and having a global mandate, can you talk to us a little bit about how the DEG exit team is organized and how you work, who works with them at DEG at different life stages in your investment?
Yes, absolutely. DEG, we found out that exits is a very specific skill set. And so what we've did, in the end, the whole life cycle of private equity breaks down in 3 or 4 different segments: origination, structuring, DD, portfolio management, exit. And exit to us is quite a bit of a different animal. Since we have a global outreach, since it's not just on certain regions, we created an exit team that's mandated to manage the exits globally. So they keep contacts to the investment banks, to our networks, who normally who potentially are interested in acquiring such assets. And they have also all the skill set, to put the necessary structures in place. So that basically happened 3 to 4 years ago. So we singled out a team. We are about 25 operators. FI Equity is about 25 operators in Cologne and elsewhere. And so we singled out a team of 3 people, and they are now really fully dedicated on exits alone. It's a bit split by region so that they can also maintain their networks, whether it's Southeast Asia or also in Africa and also in LATAM. But they can also exchange opinions on possible structures, for example, or on possible advisors. There's one or two investment banks, also global investment banks, where we made very, very positive experiences with. Some others obviously are not very much aligned with our ticket size, the tickets we have, or possibly also with our approach to exit. Because in the end, as a DFI, it's also a bit about the right buyer. It's not just any buyer at any cost. It's also about the right institution we want to sell our assets to. So that paid off, I think, big time, so that we have this team in place. And that changed things quite a bit internally, because it also took away, this very sort of responsibility from the investment teams. So they then now manage focus on the investments, on the DD and everything that comes with this, while exit is then really done by other people.
So I wanted to open it up for questions from the floor. Do we have any questions? Hold just a second. They're going to bring you a microphone.
And I took quite a bit of note with respect to a lot of the discussions, because I'm quite interested, especially based on the fact that we've not really had it very good with exits, with PE experiences in Nigeria has not been very fantastic. Asane, would you really say that you have had a successful exit in Nigeria? And that's one aspect. There's so much negativity, so much negative news with respect to the transactions, court cases, and all that. So it's something that we would really like more, if you can this is an opportunity to actually state what it is really. It would be nice to learn from your experience.
Thank you.
If you have really had a successful one, with so much illegalities and all that attached.
Thank you.
Sure, very happy to be open about it. It has been a great experience for us. We're very passionate about the healthcare sector in Nigeria. The investment ultimately was very successful in our ability to sell the business to a multinational. We did have to make what was a difficult management change, but we were majority shareholders in the business. We brought in a fantastic indigenous CEO who used to run GSK Nigeria to take the business through to a profitable exit for us, and it now is part of a conglomerate which is one of the largest retailers of pharmaceuticals in the whole country. So it's been a fantastic experience for us, and we're very keen to do more on the continent, and are looking at several other great opportunities with fantastic entrepreneurs in Nigeria. So for us, it's a great case study of having to transition a business, but in the end, it was a fantastic experience.
Thank you. Any other questions from the floor? Yes.
Hello, I'm Tanya from the Central Africa Market, Private Equity and Venture Capital Association. I would like to ask, or shall I say, just get your temperature regarding the fact that the region has been able to attract only 1% of the total deal volume recorded in Central Africa. What are your views from an institutional investor's perspective, and as a fund manager and portfolio manager's perspective? What sort of initiatives or measurable sort of actions are you taking, or what kind of attention are you planning to give to this particular state of affairs, so that the deal volume can also be can match the regional counterpart? Thank you very much.
So I can start, because Launch Africa Ventures is very active in Kinshasa, and we're blessed with an incredible and resourceful investment committee member, Hannah Sabaya, who's the Proparco Day country manager by day, right? So it's having, trusted people on the ground who can assess reputational risk and support de-risking operational risk, and obviously changing, what investment in CAR represents to follow-on investors. Franklin?
Yeah, I'll say something about that. Number one, we think Central Africa is very, very exciting for all sorts of reasons, demographic, the resource play, but also just the convergence opportunity with not only the rest of the continent, but globally. And it brings me back to something Afsani said earlier, which is we believe strongly in being sector specialists. So we only focus on manufacturing and telecoms. And what that allows you to do, I mean, obviously Afsane is an expert in healthcare, so there's a sort of similarity there. But when you can focus specifically on the drivers of a particular industry you know very well, it doesn't obviate your need to understand the geography also and the particularities of the environment you're in. But there is a shared language across wherever you're going to be, and say we look at data centers quite a bit. We look at fiber optics. We look at towers. The economics of those businesses will be fairly consistent country to country, right? At least what's important about them. And then when you talk about exits or finding financial partners for those opportunities, one of the things that being a sector specialist allows you to do is have very unusual partners, right? Because people who know nothing about the geography but are very passionate and knowledgeable about the specific sector you're in can get comfortable fairly quickly, particularly if you can persuade them that you can manage some of the sort of local contextual issues that they might not be comfortable with. So for an organization promoting a region, let's say, that might not be getting as much attention, one strategy could be picking a few select sectors where you differentiate, or there's a particular need. I'll give you an example. We had a small role in an East Asian country, a company from an East Asian country not known to do a lot in Africa, which provided an exit to a major African PE fund in the gas distribution space, right? And they had never really done anything like this before, but they really understood gas distribution very well, and we were able to help them understand that the opportunity set was interesting enough in a country that they didn't know that they were willing to stomach the sort of significant, fear of coming into a place that had bad global reputation, and it's worked out pretty well for them, and it was a great exit for the private equity firm that was involved.
Thank you. Mark, anything to add? Yes.
Maybe also to that, I think what's probably important, I mean, I was there a couple of months ago, and we also looked at an investment in the FI space. We also believe in a sectoral focus, and we are focused on FI investments. And there's two observations for the wider regions, CEMAC regions plus also DRC. First is governance and the regulatory framework. It's still for us not easy to navigate. I mean, we managed to do so, but I mean, that's definitely something probably to create more transparency on the regulatory side. Because doing financial investments, cross-regional financial investments is quite a challenge. And the regulatory challenges absorb a lot of energy to sort this all out. Different sort of bodies who need to give approvals, et cetera, et cetera. So that was quite challenging. And the second thing is, I think going forward for DFIs, particularly climate's going to play, and ESG in general, climate ESG is going to play a very big role. And when you look at those economies in that part of the world, let's say, for example, Gabon or Cameroon or DRC, I think what those economies probably have to put in place is very robust ESG and climate strategies, at least. Because for us, going forward, we will, going forward, look at our carbon footprint. And if we get invested in these economies, normally the economies are dependent on oil or minerals. So, at least it has to be somehow digestible also in the future, because it will definitely add to our carbon footprint. Even if we invest in financial institutions, the institutions or financial institutions on the ground are going to be heavily exposed, let's say, to directly or indirectly to the energy business. And so I think there has to be a strategy also across that region, to tackle that problem. How to deal with climate and ESG. I think that's a very important point.
Thank you very much. So we got the bell to say we need to wrap it up. I think I can volunteer for the panelists that if you want further question and discussion, take it outside of room 2. But thank you all for participating, and I hope this was a good use of your time, and clearly everyone understands, more richer and predictable exits in Africa is going to help the entire ecosystem attract more capital and attract more talent. Thank you.
exciting place, or much more exciting than New York. To be honest, also much better prospects in terms of opportunities. Yeah, New York is a bit like what you have here. Very separated markets, you know. I find that's pretty exciting. I invest in office property in the sector. I mean, like leads with other sectors for the economy. No files are really balanced. If you want to direct to leads, you have to. Yeah, that's the indispensable. Africa is from a regulatory point of view still a huge challenge. I mean, you have CMAC, you have Weibo, these two areas, and then people want to invest in the bank, from here and there, everywhere.
The other one's Mike's already, so we're ready to go.
Okay, perfect. Thank you. I think this one's... Thank you. Do you have your card? Sorry.
Yes, I do.
Oh, brilliant. Thank you. Cheers. Okay. Hello, everyone. If you'd like to take your seats, we're going to begin the next session, which is all about DTOS, the key partner for your African investments and projects. We'll be having